am recording this, and everyone can check back and see the recording. Now, if you have any questions, you can go ahead and just type them away. Anyone have any questions for me? I see a lot of names here that I recognize. Mentorship students and Atlas Line users, Trade Scalper users, Power Price Action users. Good to see you guys in here. Okay, so to begin, we've had some very slow activity in the markets. And this is a problem because if you can't make something out of the trades or out of the market, then there's nothing really that we can do. So I want to show you a way that we can maybe go around it or look at when the best idea to trade would be. And if it's not worth trading, maybe we shouldn't trade at all. But the one thing we have to look at definitely every morning is whether or not the market is tradable. So as you know from all the videos that I have hundreds of videos out there. The first thing we're going to do is we're going to add some type of indication of what the market is doing, and that would be the ATR, the average true range. And you can see that today the market is at 2.5 points, at least on the E-mini S&P. If I looked at a different market, the same idea is true. I still want to understand whether or not the market is tradable. So here is a great indication of whether or not it's tradable. Now, slow markets happen throughout the year. Sometimes it's because of the summer, sometimes it's because of a cycle. If you look at a daily chart, it's very common to see groupings of days that are very tight ranged, as you can see here, or days that are very large range. But these are cycles that occur. It doesn't last for an extended amount of time. So you can see here a cycle of large range days, and you can take a look at the equivalent of the ATR. And the same thing here, we have a cycle of very tight range days. And you can see the same equivalent here where the market is very slow. So there's extremes that happen throughout the year that are almost like cycles. All right, Sam, very good. We'll take a look at the ATO, absolutely. Now, some of you have the ATO, the at the open. I'll go over it, I'll show it to you. This is a method that is an opening range breakout method. It's part of the mentorship program. I used to offer it separately back in 2007, 2008, and I now only offer it with the mentorship program, but it's a very simple, I think it's a simple method, mechanical, and I still want to refer Sam to being, if there's news, I should filter out when the market's slow, regardless, but it's a nice little method. And here, now, as you see, the market is beginning to turn up. So how do we know if the day is tradable? Well, if yesterday was slow, the day before that was slow, and we are in a cycle of slow period, then I assume that we're going to have more of the same. But as soon as this begins to increase, now we're breaking out of it. So I want you to look at, on a daily chart, cycles that are slow periods and cycles that are more volatile. More volatile also could mean that we're not going to trade it. It's too volatile. So as a day trader, you should know that slow periods happen and volatile periods happen. And looking at a daily chart, we can almost tell into the future, 3, 4, 5 days in a row, you can see how this works. Even if I go back here a little bit further, you see how the market gets slower, and even though there's a trend up, the market gets slower and slower and slower, or here the market gets more volatile and more volatile, but the price is dropping. So there's no real dictation of direction, it's just the days are larger and the days have a higher volatility and higher ATR. Now, in addition to that, I don't want anyone to believe that direction or trend up or trend down has anything to do with these cycles. And I'll give you a great example. Do you see how, for example, here is a day that was pretty big and the next day was smaller, but it was a down day or short day. Market closed lower than where it opened. The next day was also a large range day, but up. Direction typically does not play a factor or does not play a role into the volatility. So you can see a day that is just as large as the very next day. They pretty much have the same equivalent. So these 2 days here have both, let's say, about 24 points here in range, back to back, high to low, but one is a down day and one is an up day. And the problem that a lot of traders make, or the issue that they make, is that because they see this day here, maybe the momentum or maybe your MACD or your moving averages are beginning to tell you, okay, now go short. It's really not the case. Markets typically do not go up and up and up or down and down and down consecutively. So instead of thinking about direction, think about this day here was a large range day. The next day I can figure more of the same, but it could be an up day or a down day. And really what that means is that trends happen back to back. Or I should say trending days. Trending days meaning a day that goes all the way up or a day that goes all the way down. They happen back to back. And the same thing, days that are tight range and that they're dojis and they're chopping around and nobody can make anything of them, that's also a back-to-back day. So don't focus so much on direction. We can look at direction in a variety of ways. We can look at for example, I have the Atlas line that can tell me direction, or I have the ABC method, or we can look at the blueprint method, which is part of the power price action. So direction isn't that important. More important is to say yesterday was a great trending day. Tomorrow or the following day could be another trending day, but it could be up or down. And the best example that I could give you would be when you listen to the man on the TV or on the radio saying, today was a great rally, 200-300 points on the Dow or 20-30 points on the S&P, and everybody's euphoric. And then the very next day, the same person says, and we gave it all back because of profit taking or because of some other issue. But both days were trending days. So I just want to bring that to your attention. So when you look at the ATO or the at the open method, I'm going to add the indicator. The indicator is part of what's included. And here is, for example, the at the open. And the at the open indicator is basically saying the market is trying to go higher. So it's trying to go higher. The market's trying to go higher, and it's telling you to go long at 21.7275. So when you enter long at 21.7275, there's a reason for it. It's not just because or it looks good or maybe it's going to continue. There are definite reasons that we have to take into consideration. So for those of you who have the at the open, you know that the first thing we have to look for is, as soon as the market opens, what is everyone doing? Is everyone buying? Is everyone selling? Is everyone in a chop? Well, we need some type of proof to tell me the market is pushing higher, because as soon as the market opens, there's usually a direction. And that direction is so strong that it usually continues, but for a very short amount of time. So the basis behind the at the open method is to say, okay, I realize the session just opened, and by the way, this can also be placed at the London market or the euro or the Australian dollar. So for example, if I placed another at the open, and instead of the US Open, I did the London Open. Here is the London Open, 3 o'clock for me because I'm 5 hours behind England, the life exchange. So this is when the market opens right here, 3 o'clock. And so you can see that the initial push in the overnight, for me overnight, for some of you maybe not, but is a short. So I want to make sure that I focus on taking a short trade. Now this 21.7150 short, or the long that happened here today, this is a little bit different than most breakout methods that most of you probably have heard of or have looked at, because there's a problem with breakout methods. The problem with breakout methods is that as soon as the market passes a resistance or a support or passes some type of price index that you believe it's going to continue, it may or may not continue, because what we're doing is we're looking at the market moving into the unknown. And whenever the market moves into the unknown, we're hoping and guessing it's going to continue. So with the at the open method, it's not just, look, let's make sure the market breaks above resistance or below support, or let's make sure that there's a trend. It's a little bit more than that. It's first, let's dictate whether or not the market is moving higher or lower. Where is the bias? Is the bias up or down? That's the first part. At least we know the direction. After the direction, I want to know, can I get a better price in order for me to go long? Because one thing that markets love to do is they love to test where they've previously been. So if I know where the market has already been at a certain high or a certain low, it's much more likely, and it's always to your benefit, to go long or to go short in order to test it. And so the problem again with breakout methods is you believe that the market is, as soon as it breaks this high, it's going to continue. Now that may be true, but how do you know for certain that it's going to continue, and how far higher, much higher, will it continue? Will it be able to make your target? Well, we don't know. The problem is that we really don't know. So the issue when it comes to breakout methods is first realize the direction, then realize where the market has traded after I realize up or down, and then look for a better price in order to test where the market has been. So in my opinion, we're always looking for an opportunity to go long or to go short in order to test where the market has been for a higher success rate. And we don't need any special indicators, we don't need momentum or MACDs or calendar channels or bands or any of those things or stochastics. All we need are the candles, the price action. If I know the market has traded here and I realize that we've already established it's an uptrend, or we've already established that the initial push as soon as the market opens is an up day or a long, great. Now let's look for an entry. The entry could be a pullback, could be a retracement, could be a continuation of it now heading back up. But at least I know direction and I'm not moving into the unknown. So that's really, really important. Now there's also a time element to this, because if I think about an opening range breakout method or breakout system, you can't really look at what happens at 3 o'clock in the afternoon or what happens 4 or 5 hours later after the market opens. It would make much more sense if, based on whatever happened overnight or based on whatever happened with news, if there's going to be a long trade, then it should be based off of, well, right away. As soon as the market opens, it's going to continue higher and give me that entry. But if it happens 3 or 4 hours later, it's no good. So there's a time element to this. Typically, I tell everyone, even though the software will plot the signals into the afternoon, I tell everyone, don't take any of these at the open trades past the first 2.5 hours, because after 2.5 hours, we're no longer looking at the beginning or the open or the push or the bias that everyone had. So if a signal doesn't generate by noon, for me noon, 12 Eastern Standard, or within the first 2.5 hours of the session, that's no longer considered the initial push or the initial move of the day. And the same thing if you look at this here, the overnight London Life Exchange Open. So the Life Exchange opened here at 3 o'clock in the morning, right here. I'm going to put a line right here. And so if there's going to be a push up or push down, it should happen sooner, right as the market opens, as opposed to later. So if this signal short happened 2.5 hours later, would be 5:30, which is here, or after, it's no good. It's no longer that initial push or that initial bias. So there's another element to this. It's not just direction. It's not just testing where the market has been. It's also, well, this move that I'm looking for is no longer relevant. And let's take a look at yesterday. So I'm not picking and choosing here days. I'm just going through the chart. and showing you what happened. So here is yesterday, and this is 9:30. The market opens just about here. And if this signal here, right here, happened, if this signal here occurred, let's say at 12 o'clock or after, again, it's no good. So we have to think about, as far as the type of trade that we're doing, is it relevant to do this in the afternoon when the focus is everything that happened here as soon as the market opens? Does that make sense to everyone? Anyone have any questions for me? Frank, Chauncey, Chong, Daniel, Ed, excuse me, Ed, Angelo, Adam. All right. All right, sounds good. Okay, so now in addition, we talk about the market being slow and how do we deal with that? Obviously, there's a problem when the market is slow because you don't get filled. So I like to use limit orders, but sometimes getting filled on limit orders are difficult because it touches your price, you don't get filled. It may touch your target and you don't get filled. So how do we deal with this? Well, the first thing we have to do is know the current conditions. It's much easier to get filled when the market is more volatile or faster as opposed to when the market's slower. So again, I know most of you know this already, but for the new people, always look at a reference point. Is the market slow? And know it. Is the market fast or normal? And know it. So you can see that I have here the ATR, the average true range, which is on all charting platforms. Now, I like NinjaTrader. If you need NinjaTrader, as you know, I offer it, and I can help you get set up with live data. There's no cost. My team does it for everyone. So if you are new to the markets or if you're interested in learning about NinjaTrader, you don't have to rush out and get a broker. You can go ahead and just email us, and we can help you get set up with live data at no charge. And with this ATR with a value of 4 or 5 typically says the last 4 or 5 candles have done X. They are slow, they are fast, and that dictates what I do into the future. And the good thing about this is that it doesn't change that dramatically. It can go up a tick or down a tick, but you're really not going to see these big movements like one candle gives you an average true range of a point, and the next candle would be, let's say, 4 points. It's very unlikely that's going to happen unless there's news or something impacts it. So at any time, you always know currently 1 point on the market. The next candle here is still about a point. Now it's 3 ticks. It's still 3 ticks. It's still 3 ticks. It's still 3 ticks. Now it's 1 point. Now it's 3 ticks. You can see that it doesn't change that dramatically. And I'll tell you, this little tool, this little indicator, whatever you want to consider it, it is fantastic because if I'm going to take a trade, I know that I can't make 5 points. I can make 3 ticks. Or if I'm going to take a trade here, I know that I can make a point. So when this trade happens here, this short, to go short right over here, the current conditions happen to be a point and a quarter, more or less. A point and a quarter, right? 1.31 is a point and a quarter rounding down. So that means I can't take or expect 3 or 4 point move. It's 1.25 points. When the market's more volatile, the ATR has a higher number, and it dictates a 1-to-1 ratio when the target as well as the stop occurs. Now, there are a few different types of stops, Eric, that I recommend. I recommend a grouping of stops. That's a good question. Eric says here, what kind of stops do you recommend? You know, the one stop fits all criteria is terrible. You can't place a trade and say, I'm going to hold on to this 21.82 short, and whatever happens, either my profit or my stop, and I'm going to walk away. What I like to do and what I teach is be prepared for in the event of anything could happen. So there are a couple of stops that I always teach, which are a combination of a time element, which is I call a time-based stop, an element of proof or a prove-it stop, an element of maybe a catastrophic stop, which you always have to have in place, an element of maybe a pivotal stop. So whatever happens first, the stop is taken. But you can't just hold on to this short or let me see here, what else we had here, or this long, this is the London Open, the long. We can't just hold on to this long and say, I'm going to wait for this to go long, and whatever happens, happens. I'm going to walk away. If this trade does not make a profit for you within X amount of candles, typically I recommend 4 to 5 candles maximum, which on a 5-minute chart would be 20 minutes, then I'm out of the trade. Sometimes it's a small win, a small loss, a break even, almost the win. So a time element is very important when it comes to holding on to a trade. The statistics show the longer you hold on to a trade that is not moving in your favor, the less likely it's going to work. You're just hoping. I hope it's eventually going to happen. It has to happen. The guy in the TV is telling me market's going to turn around. So obviously, I don't want to hold on to a trade for longer than 20 minutes, especially with a 5-minute chart, which I recommend. Now, as soon as you place the trade, it can't just be time, because what happens, Eric, if you enter long, and as soon as you enter long, the market immediately takes a dump and just goes straight down? You're unprotected, right? That time, it has nothing to do with it if the market goes down 10 points. So you have to have some type of catastrophic stop as soon as you enter, just to protect you. So I recommend at least having 2 times the ATR, which is the current conditions, with a maximum of 5 points. So if I look at this here, I say to myself, if I'm going long at 2183.50 and the current conditions are a point, this is overnight, based off the Life Exchange Open, so am I going to be in a good position to risk 4 or 5 points, or should I just risk double what the current conditions are, because that's definitely enough room for this market to breathe and to move up and down freely in order to see it through. So if I double the ATR 1 point, I would double it to 2 points. My catastrophic stop initially would be 2 points, and then as I go forward in time, I say to myself, I have my stop, this has to happen, my target has to happen within the next few bars, 4 or 5 bars. If it doesn't, I cut it loose. So you're protected with a stop, which would be 2 points from my entry, which would be here, and my target would be 84.50, would be here. So if it doesn't happen within the next 4 or 5 bars, close out the position. And you're protected in case as soon as the long position occurs, there's some terrible news that happens in the world, a natural disaster, terrorist attack, something along those lines. The market, if it happens to go straight down, you're only risking based off the current conditions. Does that make sense, Eric? Now, prove it stops and pivotal stops, they are really based off of, instead of the well, it's price action, but instead of time, it's based off, well, this is a pivot, and the pivotal stop would typically be 2 ticks below the pivot in case market tests that. You're not stopped out prematurely, and the market will continue, or you'll get stopped out. So pivotal stop, some type of prove it stop. All right. Yes, in this illustration, Angelo, this would be a 2-point stop. And the reason it would be a 2-point stop, the only reason, is because if you look at the current conditions, Angelo, down here, you see that the current conditions happen to be only 1 point, right? So why would I risk 3 or 4 or 5 points on a market with the current conditions being only a 1 point, which is typically slower, right? So there's no reason for me to hold on to a larger loss. You can set up your, definitely, Eric, you can set up your stops and your targets with NinjaTrader. And you can do it automatically with templates and things like that, absolutely. So I always prefer to use the ATM strategy. I'll show it to you here. When it comes to, so for example, I have here a few here. So if you're scalping, I have a few scalping methods. I'm always looking at, so this is a 1-point target, right? So you see here 1-point target, slow market. The stop is 2 points, which is 8 ticks. The target is 4. So when I do enter long,
order filled.
You can see that this automatically places the target and the stop. So this is very beneficial, specifically because with electronic markets or online markets, it's a first come, first serve. This is the way it works. And so if it touches this price, you want to be the first one out. And so remember, it's important that you get into an order queue and do not move these orders around. You're always being placed in the back of the line whenever you move these orders around. And obviously when the market's slow, it's harder to get filled, so you don't want to do that. Which brings me to another point.
Filled.
Actually, let me go back to let me show you another day of the ATO, the at the open method. It comes with a course and software and things like that. But I just wanted to show it to you. So this is a great trade. I started a class on August 15th, the mentorship class, and we're currently just finished here with the at the open, how it works. Everything is disclosed, so there's no black box or anything like that. So the question I had from the traders in the room, I'm not sure if anyone from that class is here, from the August 15th class, but the question was, would this trade be valid? Okay, and if you notice where the trade filled, it filled after 12 o'clock, right? So this is 12 o'clock right here, and the trade filled at 12:15. Well, I have to follow the rules. It's got to be mechanical. It can't be subjective. So when I see this occurring after 12 o'clock, it's no longer considered the initial push or the initial move as the morning session or the morning few hours begins. It's over. So according to the rules, if I'm only looking to trade this in the in the morning or within the first 2.5 hours, this is not valid. So this was a question that came up in the class, because here is when the market opens at 9:30, and the market did not give me anything to go off of. Where is the push? Is the push up? Is the push down? And so I really have to try to follow the rules. I can't just say, well, just because it happened a few minutes later, it's still good. I would have to say no to that. Okay. All right, everyone can hear me okay? Just making sure. Sergio, can you hear me okay? Scalping. Okay, great. Scalping is typically a very small target and stop. Normally, it's 2 or 3 ticks for scalping. Sometimes the market's more volatile and you can actually go for more. Sometimes the market's dead. It's not worth trading. So scalping is usually a 2 to 3 tick target, and the same thing for a stop would be between a 4 and a 6 tick stop when it comes to scalping. Here, let's go back one more day. Let's take a look here. This is the overnight here to go long at 2183.75, and here is the ATO. So let me show you here what this is all about. You see this situation here where you have 2 orders to go long. Now these 2 orders to go long are part of the at the open method, because sometimes you don't get a signal, or you do get a signal but you don't get a fill. And if you get a signal and you don't get a fill, that means the market may be too strong to the upside or too strong to the downside. So it provides you an additional long. It's called chase the trade, actually. Chase the trade. It provides you an additional long or an additional short to still get you long or short even though the initial fill hasn't occurred. And the way that works, so for example, you have your dome, you have the long set up at 2178.50. We'll imagine here
order
2178.50, and the market just shoots up like a rocket and you don't get your fill long. The chase the trade is a second order, which is a stop or stop with limit, which on NinjaTrader you press the middle mouse button down,
order pending,
and you still want to go long, so the direction long does not change. We're still going long, but we're either going to go long at this price or long at this price. So there's almost like a follow-up. If the initial at the open signal doesn't get filled because the market may be too strong up or down, there's an opportunity to still get long with the chase the trade. But again, it has to happen by 12 o'clock or the first 2.5 hours. Again, the initial push of the day as the market begins is important. If it happens after 2.5 hours, it's over. It's not worth it because now the market may be doing something else. It may be working on something else. Okay. Questions for me, anyone? So let's talk a little bit about slow markets. I invited you here today to show you really how are we going to look at slow markets and take what we can from them. So one of the things that happens with slow markets is that you don't get filled. You have your limit order, or you have this. Let me just remove the at the open from the chart. Remember, this is the London and the US, and some of you are asking for different markets. Yeah, so let me show you real quick before I go into the slow markets. Let me show you, for example, euro, right? Everyone likes the euro, everyone likes the crude oil, everyone is interested in currencies and forex. So let me just put it here for the forex, for example.